I posted this last week, but Square's the new JP Morgan, and congrats to Jay on the deal with Jack. So Square is one of my favorites, has been for a while, but here's how Square makes money. Now that they're going into the banking space and they can do lending at 10x the capital reserves they have in their possession, that is going to be a huge benefit to them. And then we'll talk more about Tidal and that acquisition, but there's a great reason that they end up acquiring Tidal. Very strategic move for Jay-Z and Jack, and the amount of data that they'll be able to get from that customer acquisition and data play is going to be amazing. But number two, transactional fees from selling products and services is number two. Number three, Bitcoin. It's a great hedge. They bought $170 million worth in February of this year. They make 63% of their money from Cash App, and then 55% of their gross profit comes from people selling on their platform. So they're in banking, transactional selling, hedging with Bitcoin, and acquiring a music service that would give them access to more customers that will potentially use either Cash App or their platform. As well played. A key tip, another way to hedge in the market when everything is falling is to get in at better prices and avoid non-competitive entries. At Red Panda, we do not die during these dips. We acquire and we wait. And I know some of you were like, hey, I don't think these prices are ever going to hit. And then Apple hit, then Amazon hit, then AMD hit, then Tesla fell to the area I said will fall. You have to plan in advance when you're going to enter. So if a house is on sale for $250,000, at what point is that house a good deal for you? It's not a good deal at $235,000. And the crazy part, what you guys don't realize, the same methodology that I've given you to be able to buy stocks, you can use it to buy real estate or businesses or commercial real estate. So once you have one system for entry to formulate and calculate your prices, you can use it for every industry that you are a part of. I want to walk you through historically what happens in February and March, because I know for some of you that are brand new, you've been kind of brainwashed into thinking that the market moves in a random fashion, or even that it moves in a rational fashion, and it does not. So I want to walk you through the stats of February and March, historically what the market has done. And I need you to know now that February is one of the weaker performing months. January, usually pretty damn good. February, not so much. So from 1980 through 2019, the average stock market returns for the S&P 500 are 0.29%, and September is often the worst month. So please write that down. The day before President's Day weekend, the S&P is down 17 out of 29 years. So does that put the probability of the market being up or your portfolio being up or down? Please put that in chat. There's enough data that has been written on investing that these drops or minor corrections should not bother you. February's expiration day was on the 19th. So once we had expiration, a lot of the money had not flown back into the market yet. And in March, the end of the month is usually weak. So if we have a drop or we're flat at the end of this month, don't be surprised. It's typical. This is the typical movement of the market. And March has been rather turbulent in recent years. So in March 2020, the Dow declined 13.7%, which was the worst March since 1938. So if we have another downslide in March or a flat, do not be surprised. There is a seasonality to investing that I need you to know about. And with the Dow being down 1,469 points from March 9th through March 22nd, 2001, this is a common occurrence decade over decade. Now, I've been telling you guys, I need you to Google when does the Federal Reserve start to print money in March. You will see a correlation between when the recession ended versus when they started printing money. In 2008 and in 2020, the market recovered. The recession ended then, but it was because of the influence of the money machine that the Federal Reserve used to get us out of danger in both instances. The last 3 out of 4 days on the Dow is a net loser 20 out of 31 years. And I have to stress this. Stop gambling, stop buying at highs, and stop buying at stupid prices that do not give you an advantage. And the hardest part about investing is knocking out all the noise and eliminating all the noise. And even if an asset that you love, like Tesla's at 850, right? It doesn't make any sense to buy it at those highs. You have to wait till it pulls back. And if you know Tesla on average is going to drop back 30 to 42%, you need to wait for those dips to buy. So for all my real estate people, you know this. If there's a house worth 1.2 million, there's no reason to pay 1.13 for it. It's better to wait till it's on sale for 700,000, maybe 560. And then no matter what happens in the economy, you can sit on that asset and then sell it again for 1.1. Please write this down. The price that you get into the market matters more than almost anything. You can't print alpha or get any gains if you're buying at top of market. And I have to stress this again, no matter how unsexy it is, and my grandmother used to tell me that you don't have to advertise or promote the truth. It is what it is, baby. Hold for the long term, 10 to 20 years, or face a chance of losing it all. And the reason why most people don't want to hold for 10 to 20 years is because they've been making bad financial decisions for the last 10 to 20. You have to choose whether it's going to end. Whether you choose to hold long term or not does not affect me at all. I know I'm going to hold for 10 to 20. And I'm going to make sure that Xander holds his for his children. And then hopefully his kids won't mess up. And then they'll hold for 10 to 20 years minimum in possession. But tonight, write this down. I want you to go through 20 stocks. Go through Portfolio Visualizer or macrotrends.net. Portfolio Visualizer or macrotrends.net. And I want you to see whatever company that you're interested in. If you've held it over any 10-year period, will you be down? The 10-year period is the second safest time horizon to hold your assets. And this applies to real estate and businesses. If you can make it through that 10-year stretch, you're okay. 20 is the number one time frame, 20-year period. Go through the 20 stocks that you like the most and tell me if you held them any 10 years, would you be in profit? That will be your determining factor if you should hold for a 10-year period or not. And the thing that I'm realizing is that most cannot trade because they don't have patience. Most are not patient because they do not want to make money. And most do not know where to get into the market. If this is you, if you can't trade, if you're impatient, you don't know where to get in, please let us help you. But you have to have your edge of where to get into the market. Write in chat, what is your method for getting into the market? And it can't be diamond hands and buy the dip and hodl. That's not a strategy in itself. Even though if they said hodl for 10 years, I would agree with it. Even with Bitcoin, if you look at the top 5 crypto assets, if you held them for a 10-year period, you would be in profit based on the velocity of them, but also the risk. You have to be able to stomach those and ride those waves out. And I can argue without the acquisition of Apple into Buffett's portfolio, and kudos to the team at Berkshire, without that addition of Apple, the traditional method of acquiring companies that are rooted in American infrastructure, I think Berkshire would be down a lot more. That $50 billion gain has helped a lot, and they're going through a transitional period where I think at some point Warren is going to step down here relatively soon after an illustrious career, which is well deserved. But this $50 billion gain is tremendous. And meanwhile, Buffett is saying it's the best business in the world that I know of. But on Twitter, if you scroll through and look, you'll see somebody like Johnny Jackass saying Apple isn't growing. There's no innovation. There are 2 pockets of investors that I'm noticing. Ones that are just getting started, that don't have much capital, that are looking for more growth, right? And then you have a seasoned investor or seasoned business person that is looking for safety. I'm going to tell you, no matter how much money you have or don't have, the number one thing that you have to be focused on is defense. It's fun to get 500, 800%, but what happens when it goes away? And I know for us, when most of us don't hit the mark that we need to, we quit. Or even worse, we finally make some big gains and then we end up giving them away, and it hurts. These are the top 8 weaknesses of most investors. Please write these down. Number 1, most do not know where to get in. Given the thousands of books and millions of hours discussed on investing, most people will not use one system long enough to know where to get in. Number 2, most do not know where to get out of the market. You need a predetermined exit, either percentage based or price based. Number 3, most will not use a predetermined exit. So if you're in a longer position around the 500% mark, if you can get that, that's probably when you should take profit. If you can get 1,000% return, great, but you need a predetermined exit for when you will leave that position or that trade. Number 4, most will not be patient to let their profits mature. So some of you are great at letting your winners run for a bit. Some of you take profits too soon. You'll get in the trade and be up 3% and be like, I'm going to take it. You have to let your profits mature at some point. Number 5, you choose to gamble over safety because, let's be honest, and I've done it, you made money mistakes in the past, and now you would rather gamble to try and make up for lost time, and that doesn't work. Number 6, selection of bad stocks doomed to be a bad business person. The thing that I see in all the meetings and conferences that I go to, in every meeting that I have, is that the good business people are always selecting good companies to invest in. And the ones that are more volatile, like Neo and Plug, right? They're buying them at such low prices, it's almost impossible to then lose. Bad business people or people that do not have systems in place, I see that they're always chasing. And how you do one thing is usually how you do any other. Number 7, most will not do enough substantial research to become an incredible investor with an edge. And number 8, most will not read 100 pages per day to get a competitive edge in the market. So let's play versus. Let's do Apple versus your company. So the company I have, revenue is $274.5 billion. The net income is $57.4. Total assets, $323.9 billion. Cash flow of $80.7 billion. And the one that I'm picking is number 1 in their industry. The company that you're pairing against my company is at number 1 in their industry. In order to pick a stock and say, hey, I'm going to pick this company over Apple, it needs to have 4 out of these 5. And there are companies in which you can argue they may not have the total revenue, but the other 4 they have. But you have to compare stocks versus another and not just gamble. We are in an extreme macro environment in which traders are succeeding incredibly well. But at some time, the table's going to turn, and 2021 will not be like 2020. It will be a choppier, more volatile environment. And you have to have your decision-making matrix in place and not deviate from it if you want to be able to get some great gains. I want to really quickly touch on return on investment models and help you out. So there's 4 that you can follow. You want to invest $1 to make 5. You want to invest 1 to make 10, 1 to make 50, and 1 to make 10. So Jay has done 2 deals with Tidal, 1 with Sprint and 1 with Jack. So he acquired it for $56 billion, and he sold 1 for partial stake, I think for $200 million, and the other one for $297. What investment model thus far has he used with Tidal to monetize? Was it 1 to 5, 1 to 10, 1 to 50, or 1 to 100? And let me say this as we get close to wrapping up. If you're not putting in an effort to get good at this, it's because you don't want it. I'm going to be real with you. There's more information flowing around these last 18 months than I think probably the last 8 years prior, and definitely 10 times the amount when I first started in 2010. It didn't take me all of this to get started. Like, either you want this shit or you don't. Every blueprint is there. You have to pick whether you're going to be a long-term investor, short-term trader, but you have everything that you need in front of you. You have to go execute. You only need 4 great companies. If you have 24 companies or 18 companies, you made your own mutual fund. For what? I don't want you to be lost like this spaceman in the forest who does not know where the hell he's going. Should you have 10 positions? Someone asked me a great question. And let's say if we hit a crash, should you sell half of your positions to be safe? I would argue that you need to just find stocks that are pretty much crash proof. So if the market goes down 50%, they may only bleed 15 to 28%. They're not going to fall 50. And definitely you don't want stocks in your possession that if the market crashes 50%, that they go down 78 or 80% in value, because those are very tough to recover. How do you know how low stocks will go? I wish I can give you an easy answer, but it's just a lot of time in the market. I wouldn't advise anybody to do 12 hours a day, but if you're doing 4, 5, 6 hours a day, and you use some of the indicators that I've given you for free on this show, you will have an idea to know how far that market would drop. But that 72 period moving average is pretty damn amazing. And then you have safeguards to preventing a stock market crash. So like at level 1, at a 7% drop, the market will halt. And then again at 13%, it'll halt again. And then level 3 is at 20%. So last year we had a bunch of halts, and I remember Amber was killing it, catching these shorts on the ES when the market was gapping down violently, right? But you have to keep these levels in mind. So please write these down. So if we ever have a hard push down and we drop 7% hard at the open, the safeguards will trigger on the platforms to give the market a chance to calibrate itself. And really quickly, let me walk you through the difference between crash and correction. So a crash is something different altogether, right? So if you look, it took about 4 years after the Great Recession of 2007 and 8 to recover. The markets took about 25 years after the Great Depression to recover. A correction is a decline of 10%. So corrections happen every month. You have to think of them as like rain cycles or when it snows. And I've been out here in New York for a couple of days, and damn, it is cold. But we don't panic when it rains or when it snows. It's the same thing. You have to prepare for a 10% pullback at any given time. That is normal. But a recession is different. As a recession is a business cycle contraction. So when there's a decline in activity overall across the entire economic landscape, and these things usually happen when there's a widespread drop in spending. Some of you keep asking, how do you find entry points into the market? I'm begging you, please go listen to that Mark Cuban episode from top to bottom. I give you everything that you need. It's probably the best episode that I created. How do you differentiate from holding a long-term position versus falling in love with a stock? I think you should only fall in love with stocks that are going to work out for you in the long term. And if interest rates go up, the easy gains will go away, but it does not mean that the entire market is going to fall as a result. Interest rates have been high before, and the market has flourished. Homework for tonight. Go look at every decade, the 1950s, 60s, 70s, 80s, and 90s, and figure out which industries did well when interest rates were higher. Now, what would I do if my entire portfolio got wiped out? I would recalibrate, write down why I bought those assets, and did I get in at the best price? But this is another reason why I stress investing in index funds, because even if you have an index, the probability of it going to zero, if you have one of the mainstream indexes, is less than 13%. And I know a lot of you are like, hey man, if the market drops, I need to get UVXY. Only hold that for 2 to 3 days max. The best inversion strategy is to buy at the best prices. You guys are going to have to practice at getting good at this. There's no other way around it. I know it's exciting to potentially catch one of these inverted assets and then ride it up, but after 15 days, 20 days, 30 days under your possession, it's going to eat away a lot of your gains and everything else. And I said this before, the ultimate hedge is owning a business or multiple businesses. Pair with stocks, real estate, life insurance, and ultimately you want to get to 24 streams of revenue. You are not going to have all of your businesses and stocks and real estate and life insurance and your other streams of revenue fall apart at one time. So in 1948, Benjamin Graham, which is Warren Buffett's mentor, bought a considerable stake in Geico. And if you go look at the returns and where Buffett got this model from, it was probably one of the biggest returns that Benjamin Graham ever got, even though his thesis was investing in value. So throughout history, no matter what you do, you cannot avoid this matrix. You need to have businesses in your possession so you're able to hedge off any crashes in the market. And I'm not saying we will, but let's plan for a worst case scenario. If we hit full recession, or even worse, full depression, and this lasted for 4 to 8 years, what would you do? Because it's better to have the fire extinguisher and not need it. So in terms of so everything with your trades, what would you trade? What would you swing trade? What would you hold for 3 or 4 years? What would you buy? Please put that in chat, because you need to have the plan before everything hits the fan. Not saying that we are, because I think people overreacted to the interest rates conversation. But if we did fall apart, what would you do? Please put that in chat. And honestly, if you panic this week, that's a sign that you did not get into the best prices. Because I'm going to be honest, like if you got into some good positions, maybe even 3 months ago, but especially like last July, kudos to those of you that were in Elite, and then everyone in Stock Club, the position you're still holding from last May, last March, still doing well. If you're just starting out 3 weeks ago, it may not be the best feeling, but give it time and things are going to work itself out. And I was going to include the screenshot of my guy who asked me this question about being down 100,000, but I don't want people to run to your page. The thing I will say to you, first and foremost, what a blessing it is to be able to be down 100 grand, right? But give it time. It's going to work itself out. Fortunately for you, you are in some great positions, but at one point you were up 500%. I'm going to tell you, trader to trader, anytime you get to that level of being down, being up 500%, that's probably when you should take profit. And I know everybody's chasing 2,000, 4,000%, 6,000. Great. Because the numbers that you can potentially hit are astronomical now. But what if that 100% gain then goes to 40? And what happens when we trade, we'll lose a certain amount of money that scars us. So the main reason I don't trade midday, because I had my biggest financial loss trading midday when the volume was its weakest. Kudos to my brother Marcus. Like Marcus will not trade around any Federal Reserve announcements, because he got clapped doing a Federal Reserve announcement and it will scar you. What I don't want to happen is I'd rather you have the pain of taking profit and being up 300,000-400,000 and getting out, opposed to being drawn down a lot and not being able to recover from it, and then potentially quitting and saying, hey, that stock market thing is not for me. The stock market is the ultimate mechanism from taking money from people that are undisciplined with no plan and transferring it to people who will follow their plan to a T, especially when you're competing against quants and algorithms. What type of companies will high interest rates affect? It depends on how high the interest rates will go. But the first ones are going to be tech that have reached their peak. Now, tech isn't going to fall apart, but you'll see a couple of pullbacks in tech. And then also companies that do not have a considerable edge, or that do not have high market cap or high market share in their space. So all the companies that were like 8th in their industry, they're going to get beat up pretty bad. And some of you keep asking about how I built my discipline. And I can give you a long, eloquent answer, but the truth is, like, you have to have a driving force in your life that makes you want to master this or something. For me, it was Xander. I wasn't this person before Xander came into existence. So you're either going to have to be so frustrated at your circumstances, or love someone so much that you want to provide for them. That's it. Everything else is conjecture. And I can ET you to death, and I can Tony Robbins you to death and tell you all these things, right? Truth is, you either want this shit or you don't. But often I found that we will sacrifice more for others than we will for ourselves, especially for those of us that are parents or have family members that we care about. So you have to look and see, who do you care about and who do you want to provide for? Type in chat, who do you want to provide for and make life a little bit easier for? That has to be your driving force. And often, when we don't have a mission that is bigger than us, we tend to be selfish and won't put the work in. Maybe investing isn't your thing, but there may be a business that is perfect for you, that if you gave your all to, you can have a considerable impact and outcome in. Someone asks, why are airline executives selling their shares? And truth is, maybe they want to secure their future. Everyone does not have the luxury of waiting if they're in an industry where they've been beat up or laid off. I get that. Ideally, I want everyone to hold for a 10 to 20 year period, but I get life happens, especially if you have kids. So a lot of people are taking profit because now the airlines have recovered somewhat, and now you can begin to see some of the gains from the shares that you've had, and they want safety. So don't chase the rotation. and when they're exiting. If your plan is to hold and you can afford to hold for 5 to 10 years, please do so. And I need to say this as we wrap up. Technical analysis means nothing without understanding the macroeconomic cycle and understanding the history of the underlying asset that you're trading or investing in. And you can disagree. And this isn't me being pompous or arrogant or being an asshole. But if you disagree, have you gotten rich from technical analysis alone? If you have, great. But most haven't. So write this down. In addition to technical analysis, because there's a lot of people talking about charting who have not charted for a year, right? And have no understanding of macroeconomics or the cycle that we're in or what they're trading. So once you understand the technicals, meaning what price is best to get in, what cycle of the market are we in, pessimism, a middle ground or euphoria or extreme euphoria, plus what the business does, then you'll have your edge. That's the holy trinity. It's not just technicals. Because some of you are getting your asses kicked using RSI alone. Oh, we're oversold, so now it's... Okay, great. And what happens? Now you draw down 50%. It's deeper than that. And then also understand, technical analysis are not concrete blocks. So just because you set a trend line at 212 doesn't mean that the market won't say, fuck your 212. And once you understand the economic cycle that you're in and the history of pricing, so go look at 20 years on that asset that you're looking at, and it'll give you an edge. And these are the top lessons that I've taken from Howard Marks. And no matter who you learn from, you understand that the lessons are all the same. So, number one, be aware of the market cycle. Are we at a top, bottom, in the middle of a cycle of pessimism or euphoria? Right now, we're almost at a top in everything. This reminds me a lot of last year. A lot of last year. Number two, returns are higher with more volatile investments, but so are the losses. And kudos to Michael Backnet. It was a great point that he made. It's like you cannot get high returns without high volatility. It does not happen. So if you want those gains, if you wanted the gains from Tesla from last year, you have to deal with the drawdown of now. Number three, you never know 100% of the time what will happen in the future. You can only play the probabilities. For me, I know if I wait to the ideal prices, kudos to you that got in on like the entries for Apple. And even if it dropped a little bit further, you weren't down a lot, right? Apple technically could fall to $83, worst case scenario. But I know the probability of it falling from 121 or 118 down to 83 is very low, less than a 4% chance. You don't want to gamble. You want to know, in terms of percentage, how will this play out before you execute the trade? And it's the big lesson that no one wants to hear, but it's the most important part of the game. So Dream Team, listen up. Red Panda Snipers, listen up. Risk control is key, and it's all that matters. I don't care how much you can make. How much can you keep, and how much can you prevent from drawing down? So let's say you have 7 losses at 1.6%. That's 11.2% drawdown. Anybody can withstand 11% drop, right? Put yes in chat if you can. 7 losses at 22% equals negative 154%. Because what happens when you draw down and you blow up your account? You put more money back in. And now you say, okay, I lost 10 grand. I'm going to put 10 grand in. Now you think that you're starting fresh, but you are not looking at the capital that you lost already. So once you get up 5%, snipers 8%, if we lock in 2, we have a little bit of safety. And then if it goes 50 or 80 or 100%, great. But most people do not have their risk parameters in place. And once you look at history, all the hedge funds, all the traders blow up accounts over the same reason. It's mismanagement of leverage and overstepping the number of trades they should take. This is very key. Love your thesis, but look for insights that is opposite of your own. I love Tesla. Been a fan of Elon since he was with PayPal Mafia. But if you read the reports, yes, the revenue could be better. They are not as stable as they could be. And even though I love Elon, he's probably one of the more vilified entrepreneurs of this era. But they are in need of a Tim Cook. They need an operator. Elon's probably one of the greatest engineers ever, arguably. But he needs an operator to help give them an edge and drive in more revenue. Love your company. And the arguments about Apple not being innovative are true to a certain degree. But the operations that Tim Cook has brought is innovation in itself. Luck helps, but excessive preparation breeds luck. So, luck helps, but excessive preparation breeds luck. And nothing is dependable as market cycles. You have to understand the market that you're in. So literally, if we're at the top of the market, please stop buying and adding positions at the top of the market. Wait for the market to drop. If the house is worth $250, wait for it to go on sale for $200. Don't buy it at $249 because the cabinets look good. And the last thing from Howard, the thing that I find most interesting is how paradoxical it is. How often things that seem obvious, which everyone agrees on, turns out not to be true. So like cruise lines last year, airlines last year, were there some gains there? Yes. No one was talking about how important it was to be into tech, but a few people, and I was one of those. Even Apple is a boring business. There's no gains there, no gains left. People have been saying that for 20 years. You can go look. And on this final note, I need you to screenshot this. I don't agree with most of the things that this man says, but this quote is amazing. You're going to pay a price for every bloody thing that you do and everything that you don't. You don't get to choose to not pay a price. You get to choose which poison you're going to take, and that's it. So you're either going to take the time to master investing and take control of your financial life, or you're going to pay the price to someone that has put all of their energy, effort, time, and energy into studying it, and they will be able to control your life. And I think that you deserve better than that. And let's be honest, it's not that damn hard. It's not that hard. Whenever I ask anyone, hey, what are your favorite companies? No one is saying, kudos to the people at Exxon, but no one's saying Exxon. It's not one of the first 15 companies that people are mentioning. You are capable. You are worthy. You deserve this. But you have to pick the price that you're going to pay. So opposed to arguing and bickering online or even in comments, I need you to choose to master this or not and pay those prices. Love you guys.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.